US inflation was much softer than expected overnight, which shunted down US Treasury yields and the US dollar. Rates were held in Korea, but with a dovish turn, and there's more signs of a softening New Zealand economy for the RBNZ to think about after its dovish pivot on Wednesday. That's coming up in our 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ Economist Maddy Dunk looks at how the RBA views fiscal easings in state budgets from cost of living measures.
The RBA has noted in some of its recent communication that the federal and state budget positions are putting pressure on the economy and do mean that maybe their job is a bit harder.
But first, in 5 and 5 with ANZ, US inflation data out overnight was much softer than expected. That pushed US Treasury yields down 8 to 13 basis points. The US dollar index fell 0.5%. Most US stocks rose on the news of falling bond yields, except though for Nvidia and Tesla. Tesla dropped after delaying the launch of its robo-taxis. That weakness in a few big tech stocks actually dragged down the S&P 500 and the Nasdaq by 1% and 2% respectively by 5 a.m. Sydney-Melbourne time. The US dollar fell most sharply against the yen, the most since May after that soft US inflation reading. Here's ANZ economist Bunzi Madavani speaking to me from London this morning. She says the 0.1% fall in the US headline CPI in June from May was lower than expectations.
The big picture from the CPI data is that energy and goods inflation, of course, is helping improvement, but services CPI, which was sticky so far, is also showing signs of cooling, and that's going to be very encouraging. I thought what's more important is this disinflation trend that we saw that did not only remain intact in June, it actually gathered some more pace as well. And the FOMC are going to characterize this as a very good inflation report, and I think the data will go a long way in building confidence about their inflation outlook.
As of 5 a.m. Sydney-Melbourne time, the Aussie dollar was up 0.2% at 67.58 US cents, and the Kiwi up 0.3% at 60.96. Number 2, Korea's central bank held rates at 3.5% yesterday, as expected, but the Bank of Korea began preparing the ground for policy easing, with its monetary policy statement taking a more dovish tone. ANZ economist Crystal Tan says the easing cycle could start in October.
That would follow a likely US Fed pivot in September. And at that time, the government is also set to tighten debt service ratio regulations, so that will help contain household debt growth.
Number 3, Malaysia's central bank also held rates as expected at 3%. ANZ economist Arindam Chakraborty says the BNM has kept its robust growth outlook, but is not looking at hiking rates, either to slow down inflation or bolster Malaysia's currency, the ringgit.
We think any increase in inflation owing to subsidy rationalization will be viewed as a one-time adjustment that should not warrant any policy rate action. BNM attributed the ringgit weakness to external factors like the monetary policy path of major developed economies. However, the central bank believes that its coordinated efforts with the government are helping cushion the pressure on the ringgit. Overall, considering its wide negative interest rate differential with the US, we do not expect a rate cut this year. We think that the BNM will remain on hold throughout 2024.
Number 4, there were further signs of weakness in New Zealand's economy yesterday. ANZ's truckometer measure of heavy vehicle movements fell 5.2% in June. ANZ New Zealand Chief Economist Sharon Zollner says the data is a good real-time reflection of GDP.
What we saw was a really sharp fall in the month of June. In fact, the biggest monthly fall that we've seen outside of COVID lockdowns. It was down more than 5% in the month, and that was on top of a fall in the preceding month as well. So overall, I think we can add it to the pile of indicators suggesting that the economy has rolled over somewhat in recent months.
Number 5, staying in New Zealand, next week's June quarter inflation reading will be important for the direction of New Zealand interest rates after that dovish pivot from the Reserve Bank this week. ANZ economist Henry Russell says selected price indices released yesterday indicated the tide on inflation is turning, although mainly still for tradable inflation.
The challenge for the Reserve Bank is that tradables inflation is incredibly volatile and it could only take another shock for it to reverse. And we're certainly seeing still some issues with tradables inflation, things like shipping costs, which are particularly sensitive to the conflict in the Middle East.
Henry Russell there. Now, in our bonus deep dive interview, ANZ Economist Maddy Dunk notes in the latest Statometer the deteriorating fiscal positions of state budgets. She talks to my colleague Alex Tarrant about this fiscal easing and whether it might be worrying the Reserve Bank of Australia.
Through 2024, the growing role of government has been a theme that we've been thinking more and more about, because government is playing an increasingly important role in supporting households right now who are finding that it's really tough. So in the recent state and territory budgets, we did see a range of cost of living measures in there to support households. Queensland, WA in particular, had reasonably strong utility rebates for households there that are on top of those from the federal government. And that is flowing through to different states and territories' fiscal positions. Most states and territories saw that their fiscal positions were downgraded in the recent budgets relative to what we were expecting late last year in those mid-year reviews.
And there is a divergence in what is being offered.
Yes, I think that's true. We have seen that different states and territories are concentrating on different things. So I mentioned that Western Australia, Queensland were focusing on energy rebates, for example, whereas if I think about Queensland, they're offering public transport at a cheaper rate for households. And that's something else we're seeing being drawn out or being offered across the country. So it is different depending on the state and territory's fiscal positions, but also the pressures that their economies are facing.
How long can these fiscal positions keep on going the direction they're going? Is there going to have to be a bit of a turnaround soon, or has that already started?
Look, I think when you add up the federal and the state and territory budgets, the fiscal easing that we're going to see over the next year and the year after is quite material. So it's around 1.3% of GDP in 2024-25, so the current financial year, and it's about 1.5% of GDP the year after that. So there's a lot of, I suppose, pressure on budget positions going forward, and given the RBA's focus on trying to get inflation back down into target, they might be asking questions about whether this will add to demand.
Has this been what the RBA has been expecting, or do you think the states have been producing cost of living rabbits out of the hat that might potentially have been surprising the RBA?
It's a good question. I think the RBA has noted in some of its recent communication that the federal and state budget positions are putting pressure on the economy and do mean that maybe their job is a bit harder and that narrow path that they're walking is a tougher. So that this has made their job any easier. I think they did expect some easing. Perhaps they were surprised at the extent of that easing.
Maddy Dunk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, July the 12th. Catch you next week with a look at what to expect from China's third plenum. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.